In this video, we are going to talk about 5 ways to avoid tax legally. So, before starting this video, please like this video and subscribe to our channel for future updates. Income is taxed at the federal, state, and local levels, and earned income is subject to additional levies to fund Social Security and Medicare, to name a few. Taxes are difficult to avoid, but there are many strategies to help ward them off. Here's a list of 5 ways to avoid tax legally. Let's start. Number 1. Invest in municipal bonds. Buying a municipal bond essentially means lending money to a state or local governmental entity for a set number of interest payments over a predetermined period. Once the bond reaches its maturity date, the full amount of the original investment is repaid to the buyer. Interest on municipal bonds is exempt from federal taxes and may be tax-exempt at the state and local levels as well, depending on where you live. Tax-free interest payments make municipal bonds attractive to investors. Municipal bonds historically have lower default rates than their corporate bond counterparts. A study of municipal bonds from 1970 to 2019 found that the default rate was 0.1% for investment-grade municipal bonds versus 2.25% for global corporate issuers. However, municipals typically pay lower interest rates. Because of the tax benefits, municipal bonds' tax equivalent yield makes them attractive to some investors. The higher your tax bracket, the higher your tax equivalent yield. Number 2. Shoot for long-term capital gains. Investing can be an important tool in growing wealth. An additional benefit of investing in stocks, mutual funds, bonds, and real estate is the favorable tax treatment for long-term capital gains. An investor holding a capital asset for longer than 1 year enjoys a preferential tax rate of 0%, 15%, or 20% on the capital gain, depending on the investor's income level. If the asset is held for less than a year before selling, the capital gain is taxed at ordinary income rates. Understanding long-term versus short-term capital gains rates is important for growing wealth. For 2021, a married couple filing jointly would pay 0% on their long-term capital gains if their taxable income falls below $80,800 and, in the case of a single individual, below $40,400. For 2022, the zero rate bracket for long-term capital gains applies to taxable income up to $83,350 for married couples and $41,675 for single individuals. A tax planner and investment advisor can help determine when and how to sell appreciated or depreciated securities to minimize gains and maximize losses. Tax loss harvesting can also offset a capital gains tax liability by selling securities at a loss. If capital losses exceed capital gains, the lesser of $3,000 of the excess losses or the net capital loss can be deducted from other income. Capital losses above $3,000 can also be carried forward to later tax years. Number 3. Start a business. In addition to creating additional income, a side business offers many tax advantages. When used in the course of daily business, many expenses can be deducted from income, reducing the total tax obligation. Especially important tax deductions for self-employed individuals are health insurance premiums, which are available if special requirements are met. Also, by strictly following Internal Revenue Service guidelines, a business owner may deduct part of their home expenses with the home office deduction. The portion of utilities and internet used in the business may also be deducted from income. To claim these deductions, the taxpayer must conduct business to make a profit. The IRS evaluates several factors, outlined in Publication 535. Taxpayers who realize a profit in 3 of the last 5 years are presumed to be engaged in a business for profit. The Setting Every Community Up for Retirement Enhancement Act was enacted in 2019. The Secure Act offers tax incentives to employers who join multiple employer plans and offer retirement options to their employees. Number 4. Max out retirement accounts and employee benefits. In 2022, taxable income can be reduced for contributions up to $20,500 to a 401k or 403b plan, up from $19,500 in 2021. Those 50 or older can add $6,500 to the basic workplace retirement plan contribution. For example, an employee earning $100,000 in 2021 who contributes $19,500 to a 401k reduces their taxable income to only $80,500. These benefits include flexible spending accounts, educational assistance programs, adoption expense reimbursements, transportation cost reimbursements, group term life insurance up to $50,000, and generally for senior managers and executives, deferred compensation arrangements. Number 5. Use a health savings account. Employees with a high deductible health insurance plan can use a health savings account to reduce taxes. As with 401 HSA contributions, which may be matched by the employer by payroll deduction, are excluded from the employee's taxable income. An individual's direct contributions to an HSA are 100% tax deductible from their income. For 2021, the maximum deductible contribution level is $3,600 for an individual and $7,200 for a family. That's it for today. We hope you found our video interesting. If you did, please give it a big thumbs up and share it with others. Also, if you haven't already, please consider subscribing to our channel. Don't forget to turn on the notification bell so you don't miss any of our new uploads. In the end, thanks for watching, and see you next time.